10 reasons the stock market could crash in 2022. A stock is a financial instrument representing a proportionate claim on a company's assets and earnings. According to recent stock market statistics and news, it's been rather difficult for investors as the market continues to fall daily. This is something that even the average person can attest to. Hello everyone, and welcome to the Trading Blueprint, your favorite financial channel where matters related to finances and business are being ironed out. So far this year, investors have experienced some serious setbacks in the stock market. So to say 2022 has been a challenging year for investors would not be an understatement. These cause an economic meltdown for countries across the globe. If you are someone who does check the news updates on business or the stock market charts, you could deduce that some of the stocks are drastically going deep. For example, the S&P 500 has been down more than 10% since the beginning of the year. Netflix down even 30% year to date. Even some of the biggest players like Facebook is also being affected, with a drop of 40% year to date, and many more. All of these companies generate a lot of cash flow into the economy. But the big question here is, what are the root causes that are causing all of these falls in the stock market? So in this video, we'll be providing some answers to some of your most burning questions. Number 1. The spread of the coronavirus. It's no longer news that the pandemic caused by the coronavirus has taken over almost all the continents, and many countries suffer great losses in terms of their economies. The coronavirus and its various forms remain the most pressing threat for Wall Street. Because the growth and virulence of the new COVID-19 strains are unpredictable, a return to normality could take a very long time. Supply chain concerns and production delays may continue throughout the year. So as long as the pandemic is still in place, the production will be arguably affected throughout the entire nation. Number 2. High inflation. In recent years, many successful investing strategies have relied on the premise of low and stable inflation. But one may want to ask, what exactly is the meaning of inflation? And how does it affect the stock market? Well, inflation is actually the change in price measures of goods and services in an economy, meaning that high inflation leads to an increase in the price of goods and services in an economy. For example, if the price of a basket of goods and services is measured by the CPI, which makes a sharp move upwards 5% in a year, then we say the annual consumer inflation is roughly 5%. Businesses and customers are frequently unable to buy as much with their disposable income when the price of goods and services grows rapidly. As a result, rising inflation tends to hinder growth and pushes the nation's central bank. Number 3. The crypto crash. A stock market is a money machine in the long run. Speculators, on the other hand, have flocked to the Bitcoin market in recent years. Observing Bitcoin grow 8 billion% in just over 11 years, or meme coin Shiba Inu gaining 46 million% in just over a year, has sparked the fear of missing out, which has never occurred before. But suddenly, a sharp bearish market was noticed in the crypto world. Regrettably, the crypto market has been unable to separate itself from the stock market and establish its own identity. Furthermore, a significant portion of cryptocurrency investors are also investing in stocks. A crypto meltdown in 2022 will undoubtedly hurt stocks that rely on the cryptocurrency ecosystem and equities investment money. According to the chart, cryptocurrencies are in a state of dip, which has caused a lot of loss in the investors' portfolios as investors commonly use cryptocurrency. Number 4. Hawkish Fed. The Fed's shift to hawkishness is another reason the stock market could take a tumble in 2022. The country's central bank has favored dovish monetary policy for much of the last 13 years. In other words, it has held leading rates at or near historic lows and implemented a slew of quantitative easing, also known as QE, programs aimed at boosting housing market confidence and lowering long-term Treasury bond yields. Beginning in 2022, the Fed will phase out its quantitative easing program and raise interest rates by 25 basis points on several occasions. As access to ultra-cheap finance becomes more limited, overall economic growth is expected to decline. This is troubling news because growth stocks have been the driving force behind the S&P 500's rise since 2009. Number 5. The Russian-Ukrainian War. Another reason the stock market has been experiencing a serious headwind in the breakout of war between nations. This has been a serious problem for the stock market. For example, the war broke out in Europe on February 24th, which was the official date that the war between Ukraine and Russia actually started. So since the war began, the market has dropped roughly 4%, and the war persists to date. As the war carries on, we can continue to expect to see red days in the stock market. Recently, there was shocking news about McDonald's, Coca-Cola, and Starbucks as they stopped sales in Russia. This has contributed to the downfall of the stock in the stock market. This is as a result of the war breaking out. Number 6. Midterm election. Politics isn't usually something that investors really have to be too terribly concerned about. However, midterm elections are scheduled for November, and the current political stalemate in Congress might have a long-term consequence for businesses and the stock market. Democrats currently hold a razor-thin majority in both the House and Senate. Nonetheless, President Biden's Build Back Better plan failed to gain traction. With Democrats taking enough seats in November, Build Back Better could become law in 2023, paving the way for higher corporation taxes. Meanwhile, Republicans gaining seats would virtually and/or surely destroy any chance of Biden's plan becoming law and removing the possibility of greater corporation taxes. China has been a headwind for Wall Street for the past 2 years. So, 2 years ago, the world's second largest economy by gross domestic product engaged in a trade war with the United States. However, regulators began cracking down on the country's largest tech stocks last year, raising concerns. Although it's a bit difficult to predict what the world's second largest economy will bring in 2022, regulators have shown no signs of releasing their grip on China's best innovators. Weakness in key Chinese stocks and potentially negative consequences for innovation and supply chains threaten U.S. stocks. Number 8. A margin-induced meltdown. The stock market could crash in 2022 because of rapidly expanding margin debt, which refers to the amount of money borrowed with interest from brokerages and institutions to buy or short sell assets. It's not all that uncommon for a nominal amount of margin debt to rise over time. Fast growth in exceptional margin debt, on the other hand, is often lousy news. Margin debt amounted to over $919 billion as of November 2021. Now that's double the amount of margin debt that existed during the pandemic's low point. Moreover, since the beginning of 1995, there have only been 3 instances in which margin debt has increased by at least 60% in a single year. It happened only a few months before the dot-com boom broke and right before the financial crisis. Number 9. Valuation. Another evident problem for the stock market in 2022 is valuation. It was noticed that the Shiller price-to-earnings ratio for the S&P 500 was at 40 during the start of the year, which was a 2-decade high. Over 10 years, the Shiller price-to-earnings ratio examines inflation-adjusted earnings. Now this is double the average Shiller price-to-earnings for the S&P 500, 16.9. What's more concerning is what happened to the S&P 500 each time the Shiller price-to-earnings has crossed 30. The benchmark index lost at least 20% each of the previous 4 incidents. With the Fed's focus narrowing, a shift to value and income stocks could be problematic. Number 10. The history repeat. Last but not least, a stock market catastrophe could be triggered by history repeating itself. For example, since 1960, only 9 bear markets have been recorded so far. That is a decline of at least 20% in the S&P 500. The S&P 500 has had one or two 10% corrections in the 36 months following each of the previous 8 bear market bottoms, with the exception of the coronavirus crash of 2020. This suggests that recovering from the bottom of the bear market is a choppy process that does not always result in a straight line bounce. So far, we've had about 22 months after the 2008 bear market bottom, and the S&P 500 has yet to witness a double-digit percentage pullback. And it's coming according to the history, and it will be sooner rather than later. Let us know what you think about this video. Share some thoughts in the comments below. And if you enjoyed this video, do not forget to subscribe to this channel and remember to hit that notification bell icon so you won't miss any of our upcoming videos. Thank you so much for watching, and until next time, take care of yourself and take care of your wallet.